Welcome, everyone, to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, tax-favored life insurance with financial planner Jerry Guttman. Welcome to the show, Jerry.
Hi, Steve. How are you this morning?
I'm doing well, and I'm past my Super Bowl, hangover.
Got over it.
Yeah. We're all past that. Jerry, you know what? You're known in the community. You do a lot of seminars. I mean, you may do more seminars in the Phoenix, Metro, and Maricopa area than any other planner that I know of. And one of the things that you talk about that I hardly ever hear anybody talk about is tax issues and tax-favored vehicles. Tell me a little bit, why have you taken your practice and you kind of studied this, and now that's part and integrated into your planning?
Well, Steve, for 35 years, I've been doing financial planning. And many of the wonderful tools that have been around for those 35 years are still here. And we avoid them. We're looking for index annuities. We're looking for index funds. We're looking for all these things because of cost, but we're not looking in the net returns and the best return long term. Taxes is huge. Everybody forgets taxes for some reason. When you look at financial planners, they don't look at your tax returns. They don't look at the net return and the benefit and the bottom line to you.
Well, Jerry, let me just go right down that. Not only do maybe most advisors do that, but I've heard you share in seminars that even CPAs are really only reactive. They're not proactive in tax planning.
Well, I teach and work with a number of CPAs and accountants and tax preparers. And they're trained to put numbers in slots as a general rule. And that's not a knock on them, but that's their training. I get regularly, once, twice a month, I get calls from CPAs asking for guidance in certain areas because that's not where they're trained. They're not trained in the net return, the net bottom line to the client long term. And it makes a huge difference to a client. It makes a huge difference because, as you know, Steve, it affects their Social Security. It affects everything. Does it affect AMT? Does it affect everything they're doing? And yes is the answer.
Well, let's talk about one of the aspects that you use of. Now, most people, when you talk about life insurance, cash value life insurance in a retirement plan, most people kind of freeze and say, well, wait a minute, I thought we were talking about retirement income. I thought we were talking about qualified plans, about how my Social Security is going to come out. I thought life insurance was indemnification or protection only. But really, the life insurance industry has really changed over my 35 years in the business. Tell me why this is such a big piece of your thinking.
Well, because it's interesting that whenever you talk to a financial planner or a tax preparer or even an estate planner, an attorney, they look at things from a 10,000-foot level, and they don't narrow it down and focus on specifics that make the difference to the individual client day in and day out. When you look at life insurance, it's always been looked at as a death benefit plan, which is really what it was designed for. However, life insurance today can be a tool to protect assets against litigation. One, very important for a small business owner. Anybody. Today we have a very litigious society. Two, you get tax-free income from a life insurance product. You have cash value in there. It's a wonderful tool to let it grow. You don't get a 1099. When you pull it out in the form of a loan, which comes out basically tax-free it's considered a wash loan. In the olden days, that was a conversation that was had very often, not as much today. And the most important part about it to many business owners is, because I do this very often, they use it as a bank account if they need to do remodeling of a business. They use it as a free money to use and pay back, and they use it for their own bank account.
Well, Jerry, let me look at this from a consumer point of view just a minute. I notice that most consumers that I meet, either in seminars or get email from the show, I always say, what is your effective tax bracket? And most of America, not all of them, but most of America's blended rate. Now, after the new tax code, who knows what that is? But in the old tax way, we would say, hey, you're in the 20% tax bracket. Why am I in ERISA? Why am I even in a 401k if my tax bracket is so low? Now, if I'm getting matched from my employer, I get that. But what about tax bracket? If I don't have a tax bracket, should I even be in a 401k? And should I look to this cash value life insurance as an option?
That's a great point, Steve. That's a fabulous point. Most people really don't know what their effective tax rate is, first of all. They really don't. Today, if you do your own taxes or you use QuickBooks or whatever the system you use, on the front it may say what your effective tax rate is. But most people that are W-2 employees don't realize the benefit of the Roth. They don't realize the benefit that they're losing in the tax advantage products out there, HSAs, Roth IRAs, tax advantage life insurance, things of that nature. They think just because this is what the conventional thought is, this is where they need to go. I tell people all the time, why are you putting it in pre-tax accounts? Make sure that if your employer has a Roth account in their 401k, that it matches it. Because many times employer matches do not participate in the Roth side of the 401k. And you're absolutely right. Very often, a cash value life insurance program benefits them significantly higher and significantly more, as I say, higher in returns over time because of the net return and the cash-free income that they get, tax-free income that they get later.
Which doesn't fall onto the Social Security provisional income test for taxation.
You're absolutely right. You couldn't be more accurate, Steve.
Okay, so think about this. We have people that really should look at this as an alternative. I'm not in a big bracket. I'm giving a basis in retirement. Number one.
Absolutely.
Number two, I'm putting an imposition on my Social Security benefits. It could be taxed because of the qualified plan that I'm in. And I have no RMDs on life insurance.
None.
No ERISA pre-59 and a half.
Correct.
So there's a lot of flexibility here.
And there's a ton of benefits. You just said some of them. There's a page long of the benefits that are there. And we can't forget also, they're left for your estate planning and for your family too. So there's a lot of benefits to it. One of the larger things that we have to remember when it comes to our planning is there's not one panacea for everybody. Everybody thinks that there's one plan. The plans that our parents have in the past don't exist today. Pensions don't exist. Millennials have to think outside of the box. Business people have to think outside of the box. They have to protect their assets. They have to put things away for themselves. And you know what, quite frankly, my father always used to say, the guy you have to worry about is the guy in the mirror. Because no one's going to think and care about your money the way you are. And you have to protect your money, Steve.
Well, let me ask you, I noticed that there's 4 different policies, cash value policies in life insurance. There's participating whole life, there's universal life, there's index universal life, and there's variable universal life. And just for the sake of our time, I'm going to pull the universal life off the table because the interest rates have been so low, they're really not a competitive product right now.
I agree.
But if you're really conservative, if you did a risk tolerance test, you may find yourself, maybe I should be doing par whole life because of my risk tolerance, or maybe I should be doing indexing. Or if I'm a young man and I understand the risk and I got a long time horizon, I might look at that. So talk a little bit about the differences in each one of these chassis.
Well, I still am an old-fashioned favorite of a regular whole life insurance policy. The cost of insurance is usually a little higher with the whole life, and the dividends are what makes that work. But the dividends aren't going to pay as high a return as the S&P 500 on an index would. However, you have consistency with that. There's something about that. But most companies don't even offer it anymore. They've gotten away from it. When they went away from being a mutual insurance carrier into a publicly traded company, most of them don't even offer them the whole life product that offers dividends anymore. I normally would suggest that people consider the index product because the S&P 500, the 70, 80, 90-year return on the S&P is about 9.5 or 10%. We've had a great 5 years in the S&P 500, but let's take the last 15 years, 17 years since 2000, it's still done very well. And if you take 30% of it, let's just say we knock it off by 30%, that's still a 6.5% return on average. That's a fabulous return. If you can get 6.5 or 7% sound, fixed, I won't say guaranteed, but there are some guarantees with a number of those insurance products that you just mentioned. If you can get 6.5 or 7% for many, many years, you've hit a grand slam. Forget hitting a single. You've hit a grand slam.
So maybe index is kind of like the in-between product because I'm not going to lose money. It has a guaranteed hedge protection at the bottom end. It'll never be below zero on the actual crediting. I'm not going to get the dividend participation on it. That's what I'm giving up.
Yes.
But 6.5%, 7% sounds pretty good to me day in and day out. When you're talking about these products and people contact you, they're going to sit there and say, which one should I do, Jerry? And to close out our segment, how do you make a kind of a measurement? Should I do par? Should I do index? Should I do variable? How do I do that?
Well, what I actually do is I do a spreadsheet for the client, and I'll teach them about all of them. And we'll do what's best for them at their age, what the different investment tools are out there, and what the cost of insurance is based on all the different companies. I don't go to one carrier, just so you know. I have a number of carriers I work with. So we do what's best for the client. I represent the client. I do not, again, I do not represent the carrier.
Well, I want to thank you, Jerry, for sharing on our tax-favored life insurance today. And keep in mind, before moving forward with any of the ideas on our show, always check with your tax consultant, legal counsel, and financial advisor. You've been watching Steve Savant's Money, the name of the game.